the loan. I basically do mortgages. Been doing this about 27 years. Correspondent lender, broker. Done just about everything out there. My company has just about every product out there. So I'm going to cover the loan process, basically the mortgage part, and then we have some other speakers here as well that'll go through, like Nick's going to talk about the real estate side. Mike is basically our marketer, social media guru guy. He's the one in control right now. So he's going to click through the slides here. So you just click through whenever, Mike.
He's the eyes and ears.
All right. Got a little quote here. Only in America can someone start with nothing and achieve the American dream. That's the greatness of this country. That is, everyone wants to buy a home. That's the number one thing a lot of us, live to do. Here in America, your home's your biggest asset, and your mortgage is your biggest debt. So we want to make sure we put you in the right program. Why do you want to buy? It used to be actually possible tax benefits. Now they changed the tax code, so you still might, if you can, exceed that standardized deduction, there still might be some possible tax benefits. But there is stable housing costs. When you buy a home, depending on what type of mortgage you get into, your payment's basically going to stay the same. You do appreciate. Your home's going to appreciate, which means you're going to build equity in your house, which is an investment. You're going to gain equity and control of your property. As you know, when you rent a home, the landlord's in control of everything. Okay. Now, rent versus buy. The average rent, and we did this, I think this is a year old. Nick might know a little bit more on this right now in the market, but I know here in Florida, the average rent's about $1,400 to $1,500 per month. That's $18,000 per year. Over $50,000 after 3 years is what you're spending in rent. After 10 years, it's about $180,000. You can get no equity when you're renting, and you get no credit score improvements. Nothing goes towards making you have better credit. Now, the average loan
Jeremiah,
amount.
jumping in on.
Yep.
Gotta jump in. Yeah,
Go ahead.
jumping in on that is that
Yep.
what we're finding over the last, I think, 6 months or so, renting is 33% more expensive than buying. Okay, so if you were to take a mortgage payment at say $1,000 a month, $1,500 a month, whatever, you're generally gonna get way more house than if you were renting at those same prices. So that's it.
Okay. Yep. No, that's true. That's true. Good point. Thanks, Nick. The average loan amount, and this was, of course, done a year ago, says $200,000. It's actually higher than that now, between $225,000 and $250,000. Assumed interest rate today is about 5.25%, let's just say. So on a 30-year principal and interest payment, that's $1,105, which is obviously less than rent. Okay. What is the risk of waiting? Okay. 2017, the average loan amount is $180,000. As I mentioned, last year's $200,000. Now it's like $225,000. Average interest rates were 4.5%. They've obviously gone up. 2017, the principal and interest was $912. So right now, if you're looking at buying because of the increased payments and increased rates, you're looking at a payment increase of $300 a month. 2019, which is actually right here. I guess Mike added this slide on here. Cool. It's right around where the average loan could be, $220,000. Average interest rates kind of predicted about 6%. They're not there. They actually did get a little bit better last week. Still in the 5s, maybe high 4s. 30-year principal interest, $1,319. That's $400 more a month just in 2 years of waiting. We get a lot of people that say, well, I think I want to wait till I save up a little bit more money, or now's not a good time. But that just shows you right there, 2 years, you got an increased payment of $400 a month by waiting. So one thing we always ask our buyers and customers before they buy is, are you ready to buy? Let's look at that situation. One thing I always look at is income, because without income, you can't do anything. Credit, everything else we can fix, we can change that. But you got to have steady income. You have to pay your bills on time, low to medium debt. Do you have any down payment available? You have to have some skin in the game, some sort of money, and ability to pay back the mortgage. If you're paying rent, if you're paying $1,500 a month, we can get you into a home. We just have to put together plan for you. Next thing to ask yourself is, hey, what kind of home features you're looking for? This is where you get with your real and you're going to tell them where you want to live. Do you want a new home, resale home? You want a fixer-upper, amenities, how many numbers, bedrooms to baths, things like that. Okay. How much can you afford? This is where you sit down with your loan officer to go through the different programs. Really, there's only 4 types of different loan programs out there. You've got FHA, which is what they say low to income, moderate. Really, it's first-time home buyers. But hey, I got an FHA mortgage, so I don't think there's a bad loan out there as long as you know how it works. So you got the FHA, little down payment. VA is for military home buyers. So if you're a military person, you qualify for a VA. You got USDA, which is agricultural. So you're going to be, you might have some up there in Saginaw. I'll see it. Everything else is usually conventional. That's going to be your Fannie Mae, Freddie Mac products. And then the special programs are what we call non-QM. Those are for, let's say, somebody one day out of bankruptcy or foreclosure. We can offer those too. We can broker that out. It's almost like private money. Now, on a conventional loan, which is going to be your Fannie Mae, Freddie Mac loan, has what's called debt to income ratios. What the debt to income ratios are is you have a front end and you have a back end. Your front end ratio is your new house payment divided by your gross monthly income. Your back end ratio is going to be your new house payment, your monthly debt on your credit report divided by your gross monthly income. Okay, so conventional allows 31% on the front end and about 50% on the back end. Now this is gross income if you're W-2 employee, and it does vary on situation. Now what happens is when we take these loans and we run them, run them through a system called AUS, the automated underwriting system. That's the system every lender in America, whether you go to John Smith down the street, Bank of America, they all run it through this system. What that AUS system is, that's the people on the secondary market, your Fannie Mae, Freddie Mac, Ginnie Mae. Those are the ones who buy these loans. So that's why these situations vary a little bit, because it might like the situation and it might not like your situation. So we don't know until we run it through. FHA has a higher debt to income. That's why FHA, they say, is for first-time home buyers, because look at these ratios. Conventional is 31 to 50. FHA is 47 to 57%. So you can buy a lot more house with an FHA loan, okay? It's pretty similar for VA. VA really doesn't have any ratios. I got somebody closed and approved on a VA loan that had a 69% debt to income. The AUS liked it. I was really surprised to show everybody in my office. Never seen that before. It's pretty cool. Here's your down payment. Now you have a couple different things in purchasing a home. You have your down payment and you have your closing costs. Down payment is your money, your skin in the game. So FHA allows 3.5% down payment. Conventional, you can go as little as 3 to 5%. A lot of people seem to think you have to put 20% down on conventional. You don't, okay? VA 100% and USDA is 100%. So great programs. Here are some of the closing costs that are involved in purchasing a home, and closing costs cannot be included in the loan. So you have to bring it to closing. A lot of people say, can I roll that in the loan? You cannot, not on a purchase. So you have escrow. You have property taxes. You have interest, loan origination fees, recording fees, lender paid mortgage insurance if there is any, which FHA has. You have to pay for an appraisal, which is the value of your home. Homeowners insurance, which covers any damage. Upfront mortgage insurance, again, that's FHA. You have title insurance, which makes sure you have a good title, no cloud on the titles. Loan discount points, if any, that's usually to buy down your rate. First payment to your escrow account, which covers your taxes and insurance. So here's all the costs in an overview. That's not everything. That just gives you an idea of what's involved. And this is something, as we sit down and go through the mortgage process, we go through this in much more detail for you too. Okay. Now you do have what's called seller concessions. Nick's out there selling real estate every single day, so he can tell you more than me on the type of market. It seems to be more of a seller's market, so it's hard to negotiate these costs sometimes. But if the seller's willing on an FHA, they can pay up to 6% of your closing costs, VA 4% of allowable fees, USDA up to 6%, and conventional, you can actually pay up to 9%. Usually it's around 3%. 9% if you're putting, I believe, 10% or more down. So that's something as we're going through the process, want you to think about. We have the down payment, which if you go FHA is 3.5% down, and let's say you have another set of closing costs you have to pay, which might be another 3.5%. Now you're looking at a total of 7% on a purchase of a home. So this is something as we go through the loan process, before you do anything, we get that pre-approval and go through that with you. Say, okay, here's your minimum down payment you need. And then here's your closing costs. If you don't have the closing costs, we got to figure out a game plan to try to get maybe the seller to pay for. Maybe we can do a lender credit, seller credit, both, or whatever the case is. Okay. A lot of loan officers don't tell you about the closing costs until, before closing. And I see it happen still today. A lot of clients are like, wow, I only thought I needed 3.5% down. Okay. Now what's cool is those funds can come from, this is where it can come from, is your bank. If you have it, it's called sourced and seasoned, so we have to know where it is. You had the subprime market, terrorism, 9/11, all these things affected the down payment. It's the number one thing that kills loans today is unsourced funds, meaning if you've got, let's say, $10,000 under your bed or in your closet, you can't use that to close. We have to know where it comes from unless you can prove a paper trail for that. Okay, so it can come from 401k. We do have down payment assistance, which can help that. Chinoa funds and also down payment assistance, or gift funds from a family member or relative. That's all good. Okay. Assets not allowed, as I just mentioned, cash, unless we know where it comes from. Matter of fact, I get a lot of people right now selling stuff, believe it or not. I got a guy just closed, actually, I think yesterday. He needed some money. He had a garage sale and sold put an advertisement on Facebook. So I just used the Facebook ad. Hey, here's where the money came from. We had a paper trail, and that was okay. Now, why be pre-approved? This is the biggest essential thing. And believe it or not, I still see people going out there, and I don't know why, but they find a house, they put a contract in, and then they do the pre-approval, which you don't want to do that, because once you do that, if something happens, you're bummed out. You're emotionally involved, you're financially involved, you're not happy. So you want to get pre-approved first. It gives you the peace of mind that you know if you qualify, you're going to know your limits, you're going to know your house payment. It shows the realtors on both sides that you're serious. And you basically 99% of the time you need it to make a purchase. Like I said, I still see them come in without the pre-approval. And it's a good negotiation tool, because as you're negotiating, you're letting them know, hey, I'm serious. I submitted all my paperwork. They pulled my credit. They looked at everything. Now, most loan officers will do what's called a pre-approval. You have what's called a pre-qual, where they pull your credit, they look at your credit, you tell them how much you make, and they're like, hey, everything looks good. You're pre-qualified. That's what 95% of banks do. Okay. Now, most loan officers will go a step further and do a pre-approval. That's where they say, okay, you told me you made $50,000 a year. Let me see that documentation that you make $50,000. That would be a pre-approval. Then they verify it. Now, we as a lender will go a step further and do what's called a TBD, full loan commitment. What that is, I, the loan officer, look at everything, but I'm not the one who signs off. We have an underwriter that signs off on this. They're the ones who give the full commitment. They're the ones who say, okay, as long as you do this, we're approved. Okay, so I'll do that on a TBD. I've got a client right now, self-employed. They've got 4 or 5 different tax returns. It's a little complicated. Even though I think it's good, I want to send that in to the underwriter. Now, there's 2 really good things that make that awesome. One, you really know you're qualified in case the loan officer messes up, because we're human. We can make mistakes. The underwriter will say, hey, I've reviewed everything. They're approved. So you know, hey, guess what? When you're making that offer and you let your realtor know, hey, I've already been to underwriting. My part is done. So now when they make the offer, they flip it around and the seller going, hey, do you even have good, clean title? Is your house even going to appraise? Because I've got a client right now that can close in 2 weeks, maybe even sooner, because you're all done. That's a loan commitment. That's what we like to do for people. Now, in order to get pre-approved, we need certain documents. One of them is 30 days pay stubs if you're W-2. We need 2 years W-2s or 1099s. We need a list of long-term debt, which is what we're going to get when we pull your credit. We actually go over that with you. I also give you a copy of your credit report. A lot of people say they're not allowed to. They can. They just don't want to. Recent bank statements. 60 days. It has to be all pages. Nothing can be blanked out. It's got to have the bank name, your name, the full account number on it. And I only ask for bank statements for what we're going to use for down payment. If you've got 10 bank accounts, you're only going to use one. I only need that one. Tax returns. I need 2 years signed tax returns. Proof of any additional income. If you've got disability, security, pension, annuity, as long as it's continuing for 3 years, we can use that. And of course, since 9/11, I need to see who you are. I need to verify you by driver's license, social security, passport. And again, here's that list. And we go through this. We give you this list as well. Okay. Now, what kind of mortgage is right for you? There's tons. There's, like I mentioned, I don't think there's a bad mortgage as long as you understand how it works and it fits your needs. You want to consider your future financial change. So we'll sit down. We'll go over, consider, how long you're going to be in the house, the savings, down payment, and so forth. Once we do that, we look at your application. We're going to go through, hey, do you want a fixed rate, adjustable rate, so forth. Now, a fixed rate mortgage payment remains the same for 10, 15, 20, 30 years. The nice thing about that is you know exactly every single month what your payment's going to be. So even if interest rates go up, as you know, when you rent, your rent's changing every single year. It just is. It always goes up. And like as Nick pointed out earlier, it's the first time in a long time where rents are actually higher than mortgages right now. Adjustable rate mortgages. These are awesome when rates are really high, and especially if you're in the home for short term, maybe 2 to 5 years. Adjustable rate mortgages can be really good. Okay. You can go to the next slide. Like possibilities. 30-year, 15-year, what's going to be better? 30-year, you're going to have lower payments. You can afford more of a house. A 15-year, you're going to have a higher payment, but you're going to pay it off sooner. I see a lot of these advertisements, Quicken Loans is shooting, hey, 15-year, 15-year, 15-year. I don't know. I've been doing this 27 years. I think I've done maybe 2 or 3 15-year mortgages throughout my life, and they've all come back to me and said they want a longer term. Because right now, when I first started, there was a lot of prepayment penalties. There's no more prepayment penalties anymore. So you can take a 30-year mortgage and pay it off in 15 years by adding extra towards principal. But the nice thing about the 30 years, you have the flexibility. 15-year, you're locked into that payment. Special programs that we have, mentioned first-time home buyers. We do have down payment assistance available. MCC credit, that's an awesome tool to get us a little bit more income. It's not supposed to be used that way. It's actually a tax benefit. But with the tax benefit, we can use it to increase and add extra income. So let's say, I don't know, in your area, the average home is 150 or 170. We can only get you qualified for maybe 150. You're a first-time home buyer. I can say, hey, I can give you the MCC credit, which allows you an extra $2,000 a year credit. So now if you divide that by 12 months, it's $167 a month in income. So what that does, believe it or not, just $167 a month in income is going to allow you to purchase an extra $20,000 in purchase price. So that's a great program to be added. And again, irregular income or self-employed. Okay. All right, then guess we're going to throw it off to Nick to talk about what he does on the real estate side.
All right, Jeremiah, great job. Thank you. Yeah, than's for doing that. Hello, My name is Nick Tracy. I work here at Keller Williams Lakeside out in Shelby Township. Quick thing about myself, I'm a part of a team, the Tom Lipinski team here. We have a team of 7. I'm the director of sales. We have a couple of agents that I'm responsible for, and we have a couple admin people as well. So I've been selling real estate for almost 10 years now, and I'm going to present the A to Z's of buying a home in today's market and touch on a couple of things that Jeremiah mentioned previously. So I guess just a quick update on the market is that generally we are in a pretty aggressive seller's market, okay? And so in Macomb County, I'll just use basic stats. In Macomb County, the average list price to sales price ratio is 98.7%. Okay, so when a homeowner lists their house and it's clean and it's move-in ready and it's in, it doesn't need a lot of work, then generally they're getting 98.7% of their asking price. Okay, which is relatively aggressive, you know. And so when you're buying a home in a seller's market, the main thing, my main advice is that you're going to be as aggressive as you want to be. Okay, if you don't absolutely have to have the house, then you don't have to compete, you know. But based on what the stats are showing us is that if a house is in a good area and it's clean and it's ready to go, it's generally going to sell pretty quickly. Okay, so that makes a difference when writing your offer. Okay, so to Jeremiah's point is that seller's concessions is where the seller assists you with their closing costs. Okay, and what that means is that it's essentially money off of their bottom line. Okay, so you take a $200,000 house and you ask for $5,000 in seller's concessions. Generally, that's a $195 offer to the sellers, right? And which is fine, it's great and everything. But when you're competing with other buyers in the marketplace, sellers' concessions are generally the first thing to not get written up in an offer. Okay. Now, like, let's say that a house has been on the market for 30 days, 60 days, 90 days. You could ask for seller's concessions, right? Because that home has been sitting, and it's likely that you get a better deal on it. So it's a case by case basis, all dependent on the area and on the house and how long it's been on the market. Okay. So we go ahead and hit the slide. Okay, all right, perfect, cool. So so when you hire a real estate agent, the first thing that you want to do is, number one, get pre-approved, to Jeremiah's point. And that's, because like it's important to me as the real estate agent that you're financially comfortable with whatever house you purchase. All right, because you want to know the your cash to close and your monthly payment. And the monthly payment to me is even more important because that stays with you. It stays with you through the life of the loan, right? Of course, if you refinance, things could change there. And then your down payment and your closing costs, yeah, you're spending that money and you could always earn it back, but that monthly payment sticks with you through the long into the future. Okay, so yeah, so when you hire a real estate agent, the first thing you want to do is a needs analysis. All right, so like what I do on my team is that I'll sit with a buyer for 30 to 45 minutes and go over a real in-depth consultation on what you're looking for, what regarding areas, kinds of houses, bedrooms, bathrooms, garage, basement, stuff like that. And we'll really identify your have-to-haves, like your non-negotiables, versus what you would like to have. Okay, and from there, I'll enroll you in the multiple listing service database. Okay, so that is the database where all the homes for sale go. Okay, now when everybody starts, they're always looking at Zillow and Realtor.com and Trulia, and those websites are great. Yet those are marketing websites. And my database, the agent database, Zillow and Realtor.com, they pull their data from my source, the multi-list, right? And so the reason why that's important is that sometimes Zillow and Realtor.com, they could take a day, 2 days, 3 days to pull the houses for sale to put them in their database. Okay, so when you're a buyer and when you're actively looking at properties, Zillow is not acceptable if they're late to the game, if they're late to pull their houses for sale from the multi-list. Okay, so point is that we'll enroll you into that, and then that way when a homeowner hits the button on a house that is parallel to what you're looking for, you're going to get it within 10 minutes. Emailed, texted, and then I'm picking up the phone and calling you, hey, there's a new listing that just went live. Let me know what you think about it. And then from there, we would get in the car and schedule and look at some houses. So generally you can see 4 houses in an hour based on how far away they are from one another and how large they are. If there's basements, take more time than homes with no basements, right? So it all depends on the kind of house. Okay. Generally, you don't want to see any more than 5 in a tour, just because after 5, it gets to be a lot. Like you don't know like the 8th house from the 2nd house. It tends to overwhelm buyers. So, and in this market, I always tell people we should be looking at less houses more frequently because they sell so quickly, right? So these days, like we can't oh yeah, we'll get to it next weekend, or we'll get it on our next day, on your next day off, because it's likely that property is going to be sold. So if you like it, and it, chances are other people like it. So we should be seeing more houses less frequently. If we have to go out 2-3 times a week and look at 1-2 houses at a time, then that's just the way it is, because that's the market that we're in. Okay. Let's see. Yeah. So yeah, you can go ahead and hit the slide. All right. So it's like, there's different kinds of relationships that consumers have with real estate agents. Okay. There's the listing agent, and then there's the buying agent. And sometimes there's something called a dual agency. So dual means two. Okay. So real estate agents have a fiduciary duty, a by law duty to represent their clients a certain way. Okay, like a listing agent, it's their job by law to get the highest possible price in the shortest amount of time, the fewest amount of hassles. Okay, on a buyer agent, it's the other side of the coin. It's a by law responsibility to get you the lowest possible price at a home or in an area that you're comfortable with in the time frame that you desire. Okay, so some consumers, they're fine with like calling on signs, like they'll drive through the neighborhood and call the sign that's in the yard, and that's always not the best route, because you're calling on a sign that's representing the seller. They're not representing the buyer, right? So it's like, if I call a sign that's in the yard, I'm calling somebody who's doesn't have your best interest at heart. Okay, and that's where a buyer agent comes in. It's like a buyer agent. I work with a lot of buyers, is that I show you every single house that's on the marketplace, that's in the marketplace, and we're going to show you as many houses as it takes for you to find the perfect one. Okay. And my advice on that is that when you're touring houses, just let me, I'm saying me, or a real estate agent, just speaking generally, let me know what you're thinking, because that way I can help you find the perfect house, not just mindlessly opening up lockboxes. You want to communicate with your real estate agent what you're thinking, because it's not going to hurt their feelings. It's not their house, but just let us know what you're thinking to evolve the process to help you find the perfect one. Okay. Dual agent, quickly on this. So dual agent means that the real estate brokerage is representing both sides of the party, or both sides of the transaction. Okay, so like my office, Keller Williams Lakeside, is the #1 office in Macomb County, and we have 425 licensed real estate agents in this office. So it's likely that you might be looking at a house that's listed through this company, okay, or any other company. And it's not like that I know the sellers or the sellers know you, but it's just identifying that the brokerage is representing both the buyer and the seller. So.
Hey, Nick.
Yes.
Who pays the buyer's agent?
Oh yeah, that's a great question. So the buyer agent has no fee to the buyers. All right. So when you work with a buyer agent, it's totally free. The commission that we earn is paid on the seller side of the ledger. So when you're a homeowner, you pay the real estate commissions, and a portion of that commissions goes to the buyer agent. And we don't get paid until you close on the house, right? So it's like you don't, as a buyer, like you don't pay anybody anything until you have a purchase agreement in place, which we'll talk about the costs. I mean, Jeremiah, you pointed out the appraisal, and then there's also a home inspection, which we'll talk about in a second. So yeah, great question.
Yeah, cool. Yeah, I just wanted to mention that because I see a lot of buyers come to me and they think it costs money for a buyer's agent, so they end up calling the listing agent, which, as you just pointed out, the listing agent represents the seller. They don't look out for the buyer's best interest. So that's why it's always good to have a buyer's agent, because they're going to look out for your best interest.
Yeah, for sure. And then yeah, when you're shopping around buyer agents, look for somebody who's not going to sell you on a property. It's like, you're going to know if the kitchen is awesome or if the basement's nicely finished. Like, you're going to be able to see that for yourself. You want to hire an agent that is that sells real estate with a real consultative approach. Okay, like to where it's like, my job is to give you empirical data and guidance for you to make the best decision possible, because it's your house. Like, I'm not living with you. So it's my job to find you the best fit for your needs, not necessarily anybody else's, right? Because it's your house, you're buying it, right?
Yeah, good point. Yeah.
So, all right, yeah. So start looking at houses. Yeah. So we briefly talked about this. Is that, yeah? So you're going to want to have a conversation with yourself and your family and your real estate agent, like what you absolutely have to have and what you would like to have. And I would focus on negotiables and non-negotiables. Okay, like area, school district, basements, Those are something you're not going to get around. Those are your non-negotiables of a house. Bedrooms, even if you have a family. Stuff that maybe you could get around is like fence. I have a lot of people say, well, I got to have a fence. Like, okay, well, if the house doesn't have a fence, yet you could put up a fence, is that something that you would be open to? And they say yes. So it's like negotiables, non-negotiables, and then what you would have to have versus what you would like to have. And then from there, we would iron all that out. Like a lot of people say like, well, I got to have 1,400 square feet. Okay, that's perfect. Thank you. 2 questions. What's important to you about that size? And would you consider a house that has 1,399 square foot? I'm sure you would, So it's little stuff like that. And then when you're looking at houses, you're going to learn. It's a coaching opportunity. It's like you're going to learn what you thought that you didn't like and you actually like, or what you thought that you liked and you don't like. So the best way to do it is that after you're pre-approved and after you've decided that you're going to buy something, you got to get in there, and actually put feet on the ground and start actually looking at houses, because pictures only do so much. You can hit it. All right, so we had our needs analysis conversation, right? And so you met with your agent, you understand what you want. We're looking at houses. We found the house that you got to have. Now we move forward with the offer. Okay, so the biggest thing in this market is the supply and demand. Okay, it is likely, if a house just gets listed, it's likely that you're going to be competing with other buyers. That is going to be the driving force of the offer that you write. Okay, is the competition. Okay, if you're competing with other buyers, the idea is to win the competition, to beat out a multiple offer situation. All right, so that's the biggest thing to know when you're writing an offer, is that are there other buyers that are writing offers, and are you in a people like to call it bidding war. I just call it, it's like, place your final and best offer, and then they're simply going to say what they're going to say. And the mindset behind that is that if the house were to sell for $1 more than what you're willing to pay, you got to be okay with it, because you didn't like the house that much. I hope that makes sense. So when writing an offer, there's a couple of characteristics about it. And, number one's the financing. Okay, so you're going to have all of this dialed in before we actually write the offer, but whether you're FHA, conventional, VA, all the loans that Jeremiah mentioned, that will be put in the purchase agreement, and your down payment will be identified. It's normally on page 1 of the contract. So, and that, sellers like to see that, because they want to know how much money you're working with. Okay, because it makes you more of a qualified buyer. If you're putting a less down payment, that's okay. It doesn't make a difference, but it has to be spelled out so title company and the lender knows what down payment and what you're ultimately borrowing. Okay. Like I said a second ago, like days on market. So if a house has been on the market for 30, 60, 90 days, then we'll do a market analysis on the property to understand what neighborhood homes are selling for. Okay. So if a house is listed at 150, but neighborhood comparables are only showing 140, then we're going to come in at 140 or less to try to get you that better deal. Okay. So, it's reviewing. So we'll understand what the neighborhood is selling for, and then that'll ultimately be our offer price if we're not competing with other buyers. If we're competing with other buyers, it's likely that you would have to come at or above the asking price in order to make you look good to the sellers. And again, you're never going to be put in a position that you don't want to be in. This is ultimately going to be your call. Like, your agent should be telling you all of this, and then ultimately you're going to make that decision for yourself. Okay. Like, what is the seller's situation? It's like, it's good to know if this home is in an estate, or if it's in a trust, or if it's a distressed sale, because normally that means that they're a little bit more motivated, and that is your buyer agent's job, is to get all of that information for leverage for your offer. Because we want to know how motivated they are. Okay, so earnest money deposit. So earnest money deposit is upfront money that goes towards the purchase price of your house. It goes towards your final number at closing. Okay, so it's usually between 1% to 5% of the offer price. And this is in the form of a personal or certified check. And I would collect this from you once we're writing an offer. Okay. And now you could chalk this up to it goes towards your down payment or it goes towards your closing costs. It's money on your behalf. Okay. And if we're competing with other offers, I recommend as much as you're comfortable with. You know, I've done $10, $20, $50,000 earnest money deposits because it makes you look good to the seller, and it goes into my office's your real estate agent's non-interest bearing account. And if your offer were not to go through for any reason, you would get that money back. The only time that you wouldn't get the money back is if you just straight up did not come to the closing. Okay, like because you would be at fault for that. But if the home inspection is if the home inspection fails, which we'll talk about that in a second, or if it doesn't appraise, if there's some elements with the approval, or excuse me, with the offer value itself, you would get that earnest money deposit back. So yeah, you would forfeit it if, like I said, you just straight up don't come to the closing. So yeah. All right, so now we're actually putting pen to paper and we're making the offer. We're spelling out all of the specifics. And that includes the legal description of the property, because the address is really just for the post office and DTE. The legal description is ultimately what you're buying. You're buying the land, and the house just happens to be on it. Okay. So yeah, this is I say, like, crossing the T's and dotting the I's on the specifics. It's including your down payment. It's including the earnest money deposit and for how much, which we just spoke about. The closing date. All right. So on a conventional loan, your closing date is between 30 and 35 days. Okay. FHA, it's a government loan. It takes a little bit longer. It's about 45 days. Okay, which is not a huge difference, but the closing date is going to be put into the purchase agreement, and they're taken seriously. Like all parties are revolving around that date. Okay. Appliances, pool table, whatever, everything that's being left with the property would go into the purchase agreement, except for personal items. Okay, sometimes, like pool table is a good example. Sometimes sellers leave personal items, but lenders don't really acknowledge personal property. Okay, it's either the appliances and then anything else we would have to put in writing separate from the purchase agreement. Okay. Yeah, so closing dates. Yeah, so starting the mortgage. Oh, okay, quick thing about the offer is if the property is still being lived in by the sellers, there's something called occupancy. Okay, and the occupancy means that the sellers are going to live in the property after closing. So you as a buyer, after you close on the house, you're now a homeowner and you're also a landlord. And that happens a lot when sellers have to sell their house, get their equity, and then go buy something. That happens a lot. Or if they need time because they don't know where they're gonna move to. Normally it's 30 days. I've seen 60 days. I've seen 7 days. That is spelled out in the purchase agreement, and you're going to know about that straight away. Like, it's going to be in the purchase agreement, and you'll know when you get the keys. First thing. Okay. And money is held from the sellers. It's rent. It's a per diem. That means per day. Those sellers are going to pay you a per diem fee, which is normally your mortgage payment divided by 30. Okay. So yeah. So like when we're closing, it's exciting, and like you don't get the keys just then, but you would get them as soon as the sellers move out, and then your rent would be paid to you.
And again, Nick, that's negotiable. They don't have to do that, of course. Like, they can say, no, we don't want that, right?
Yeah, it is negotiable. And a lot of times, with sellers, is that you kind of got to do what that's,
of course.
It's not about the money. It's just about like the time. It's like, hey, I appreciate, you giving me a good offer. I just simply have to sell in order to buy. It's definitely negotiable, and sometimes they don't need what's written in the contract. Sometimes they need 30 days and they only take 2 weeks. So yeah, there's a lot of moving parts on that, and then we would get some specifics when we're writing the offer, and then even more as the process continues.
Okay. Awesome, good stuff.
Alrighty, so it's like, so again, so your mortgage rep and your real estate agent, they really have to have a good relationship, and they have to communicate well to one another. So it's like, I always like to say is, we're at the beginning of this process. It's your getting your pre-approval dialed in, and then from there, the real estate agent and the buyer, like, we're out in the field, we're pounding the pavement, like we're trying to make something happen to get you a house, right? And then once we have a deal, a fully executed purchase agreement, I take that package and I kind of pass the baton over to the lender. Okay, and then he's going to get going on the mortgage application. Now that he has the property address, he has the property taxes, he can start nailing down some specifics on the to the penny of your monthly payment, cash to close, and stuff like that. So we're getting the ball rolling on the mortgage process while we're doing our home inspection on the property, and I think that's coming up.
Okay. Yeah, that's pretty much when our job starts, is once you get an executed contract. Now, I did mention earlier we do a TBD where we can basically do this part up front instead of after, because this is the normal process. Once you get a contract, now the lender starts the job. Okay. If let's say we did this before you got a contract, now I got a contract. Really, the only thing I have to do is, like Nick mentioned, well, put the property address in, pull the tax record, make sure, do the appraisal, make sure the home appraises. And while all of this is going on, you're working with your realtor to do the inspection and things like that to make sure everything's good. You're going to want to get, and here's the home inspection, I guess. And here's some things. You and your realtor will set that up. I'll let Nick talk about the inspection.
Yeah, and then quick thing, good call, because you mentioned something. What we could do is that while we're looking at properties, and let's say we have time for this, you could send, or I could send over the address with the taxes, and I'd be like, hey, Jeremiah, can you run the numbers on this house specifically? Because maybe the taxes are a little bit more expensive, or maybe there's a little bit more that you want to spend. We could do that while considering writing an offer too.
Yep. Yeah, and you always want to do that too before you put the offer in, and your realtor will usually send that over. You will. I'll give you an example. I had a guy that I pre-approved in Royal Oak. I forgot the purchase price of the house, but we estimated $250 for taxes. Well, he went ahead and put the offer in without talking to me. Now I got the offer back. Well, instead of $200, the taxes are now $500 a month. So his payment went up $300 than what we estimated. He was fine with it, but it's just one of those things I like to tell people before you put the offer, and your realtor can tell you, and we can tell you, is like you said, when you're going over that offer together and it's saying, hey, I want to make this offer, I want to do this price, hey, what's my payment going to be? Okay, I can handle that. Let's submit the offer. Okay,
yeah,
so
for sure. And
we're all communicating.
Yeah, 100%. Yeah, and that's the theme here on all of this, is like the money's got to make sense. That property is going to be out there, whether it gets listed tomorrow or it'll be listed in 2 months. That's beside the point, is that you got to be comfortable with your monthly payment and your cash to close before we do anything, So yeah, that's what's happening with that. All right. So, okay. So now that we have a fully executed purchase agreement, the home is now exclusive to you. All right. It's going to go pending in the multi-list, and we're moving forward with this transaction. And the first contingency is your home inspection period. All right. So this period is between 5 and 10 days from executed purchase agreement. Okay, so let's say that the seller signs on a Monday. You have from Monday, we'll use 7 days for an example. You have from Monday to Monday to do your home inspection. Okay, and a home inspection in this market these days are for big ticket items only, right? I kind of look at it as a go or no go kind of contingency period, And it's like, the reason being is that we're in a market where we're either going to negotiate the best possible price or beat them up on the home inspection. We're not going to do both, okay? Because it's a relatively low inventory market, and like I said, it's your opportunity to really go to school on your new home. All right, so a home inspection is about $350. All right, you could hire a licensed professional home inspector, which is what I recommend. And they'll give you a full-blown analysis on the house. Like they're going in the attic and looking for mold. They're taking off the electrical panel cover and making sure everything's wired correctly. Foundation issues, plumbing, furnace. It's like everything that you can think of, they're putting eyes on it. Okay. Now, with that being said, is that I recommend that you hire a real estate agent that knows a thing or two about houses. Okay, because like me, for an example, I can expedite condition issues of homes. Okay, like if the roof is shot and you have foundation issues and the furnace is old, it's not a reason to not buy the house. You just got to make sure that you're allocating funds and you're getting a good price for it. Okay, so it's like I can coach you through all of that. So just make sure that you have an agent that that is educated on houses. Okay, but like I said, a home inspection is a full-blown analysis of it. So now let's say that let's say you're at your home inspection period and there's some stuff that you're not comfortable with. All right, you have three options. You could just accept and move forward because you want the house that bad. You can withdraw from the offer 100% and still protect your earnest money deposit. You know, we spoke about that a minute ago. Or you can ask the sellers for some things. You can ask for repairs. You can ask for money off the price, or you can ask for sellers' concessions for you to do the work yourself. I recommend option 3. Have sellers' concessions. That way, that money stays in your pocket at closing, and you can do the repairs yourself. Okay. If you ask for money off the price, like that's great and everything, but your monthly payment's only going to go down a few dollars a month, and your cash to close is only going to be a couple $100 less at the closing table. So it's like that really doesn't do anything for handling these repairs. Okay. And again, it's going to be your call. It's going to be your choice. These are just the options, you know. Concessions I like because it's like real dollars. You know, you ask for $1,000 in sellers' concessions to do repairs, that money stays in your pocket at closing. It works harder for you, you know. And if you ask the sellers to do repairs, like that's great, but it's like you never know who's doing the work. You know, it's likely that they're going to want to get it done, as affordable as possible. And, you know, it just, again, you're doing the work yourself for your own peace of mind because you're hiring your own people. Okay. Yeah. And it's like if you're going to ask for repairs, the mindset to have is that, is this going to be a problem for any buyer? All right, because it's not really for like home inspection periods are not for like stained carpet, or they're not for, oh, well, the kitchen is dated, you know, because we saw that when we wrote the offer in the first place. It's for unexpected items that would be a problem for any buyer. So again, case by case basis, we just got to get in the house and figure it out.
Yep. Awesome. Good stuff.
Okay, so appraisal. Okay, so it's like we found the house, we have an offer accepted, we have the home inspected, and everything's fine on that. You're real comfortable with the condition of the house. Now, again, the baton is passed to the mortgage officer to order the appraisal. All right, so the appraisal is about a 2-week process for it to get ordered, completed, and returned. And an appraisal just means that the lender is ensuring that the property is worth what we are offering to pay for it, okay, or what you are offering to pay for it, okay? If the appraisal comes back short, there's 3 options that could happen. Either the seller comes down to the appraised value, the buyer makes up the difference in cash at closing, or a mixture of the two, little half and half, or worst case scenario, the deal would fall through and we would have to go find another house, and that property would have to go back on the market. Okay. Now, that is going to happen all based on how far off the appraisal is, which is why we want to be smart when we write the offer in the first place. You know, we have to make sure that the value is there, you know. So again, that's all based on the house. You know, it's like if it's a $100,000 house and we're competing and we're multiple offers and everything's crazy, we're not going to offer 150 because it's not a 150 house. You know, it's like we have to be smart about the offer we write, not just about the price. Okay. And that, I think Jeremiah mentioned this, the appraisal is about $500, and you would pay for that at the time of the loan application, right?
Mm-hmm. Yep. Yeah, it's about $400 to $500. Really, that would be the only out-of-pocket cost: the appraisal, inspection, and maybe earnest money, which, as you mentioned earlier, can go towards down payment and closing costs once they close.
Right.
Okay. Okay, next slide, Mike.
So, so closing. All right. So we're a month and a half in. Once your file comes out of underwriting, which they're just crossing the T's and dotting the I's on your loan, that's when we're setting the closing. So normally it's the buyers and the sellers, and then the title company. The title company insures the transaction, and it takes about an hour and a half, depending on the copy package and just human elements, you know. And you'll either get the keys at closing and everything's happy, and or the sellers are living in the property and then you get the keys at a later date. So when you are closing, you want to make sure you bring your driver's license and then either a certified check for your funds made out to the title company. That'll be explained to you when you're going through this. Or you wire the money to the title company's account. All depending on how much money it is. I think it's depending on the title company, it's $20,000 or more. You have to wire it. 20 or less. It's all dependent on the title company. So, yeah, and then from there, like your deed is recorded, and then you're going to want to go to the city and file your name under the house, so your taxes stay homesteaded. There are 2 forms that will give you at closing, and you would take them to City Hall. Oh, and then right before the closing, we're going to do a final walkthrough, and that is to ensure the property is how we left it. So if we're closed on noon on a Monday, we're going to go there on Sunday or Monday morning to just make sure that everything is the way we left it. And if it's not the way we left it,
they didn't put no holes in the wall, mark it up.
Exactly. Yeah, exactly. Hole in the wall. And like the refrigerator's missing. A lot of stuff like that can happen. It normally doesn't. Sometimes it does. And if the condition is not how we left it, or if you're not happy with it, we would stop the closing, and the sellers would have to make it right.
Yeah, we've seen a lot of that when the market crashed.
Yeah. Oh, yeah. Right. Exactly. Yeah. Right. I thought this house had a roof.
Yeah. Hey, where'd all the plumbing go?
Right,
yeah, we've seen it.
Right. This house had a furnace, right? Yeah. Exactly.
Okay. All right. I think we got the insurance.
Yeah. So it's like so that was the process, and now Jordan's going to take over.
Yep. Perfect. Thanks, Nick. So you've got a lot of information from Nick and Jeremiah, and I'm going to try to go through it and simplify insurance the best way that I can. I'm not going to really touch upon, I'm with Provision, and we're an independent insurance agency, but I'm just going to really focus on homeowners aspect of insurance. So a little bit about Provision, because I get asked a lot of times, well, Provision, I've never heard of you before, right? We're not the insurance company. We're an insurance broker. So in 2018, we were named top 10 fastest growing property and casualty, which home and auto insurance agencies in the country. Our top independent agency in the United States, 3rd-year running for new business with Liberty Mutual. So we're a provider of Liberty Mutual, as well as AAA, Nationwide, MICO, Progressive, and Westfield. A matter of fact, we write more business with some of those carriers than their own personal agents do. So I'm a broker, and the difference between somebody that's broker versus captive is kind of like, I'm using kayak for an example. If you were to go online and book a flight with Delta, they only offer you Delta Airlines. But if you go online and look at prices for kayak, they show you JetBlue, Delta, Southwest, US Airways, so on and so forth. So like State Auto only has State Auto insurance, homeowners insurance, I have 20 different carriers that we work with that we're able to provide you a quality quote with different rates. So here's a list of all of our carriers. And the best way for me to explain it is if you were going to play poker and you could have 20 different hands versus one hand, better option of winning. So each company, when I say that, I get a different rate. If I put your home through, once you've picked a home with Nick and you've already been approved, and I'm going to put your home, same information with all of our different carriers. And they're going to evaluate it based on age of the home, based on when the roof was updated, based on the zip code, so on and so forth. And shockingly, with all 20 of those carriers, I could get a price from $850 all the way up to $8,000 a year, right? So, and the reason for that is every insurance company evaluates risk different. And that's the best way that I can explain it. So there's different ways, in order to have your monthly payment be less, one way to do it is increasing your deductible. So understanding that if you have a lower deductible, meaning $500, $250, $100, your monthly premium is going to be higher. However, if you have a higher deductible, is the money that comes out of pocket when you have to make a claim of $1,000, $1,500, $2,500, $5,000, or even it goes up to 1% or 2% or 3% of your dwelling costs, then your monthly payment is going to be a lot less. So here's, when you look at your homeowner's insurance, there's a lot of information on there. And I think this page here best explains what exactly your homeowner insurance looks like and what it's covering. So the first thing it's covering is your dwelling. If your dwelling was to get destroyed, right, by wind, fire, lightning, or an internal explosion, that number is the cost that it would take to rebuild your home today with today's materials on your already existing property. Your other structures is things like your detached garage, your fence, your shed, your pole barn. And that's going to be a certain percentage of your dwelling. It's about 10%. Now, with your personal property, that's everything in your home. If I literally took your home and I was going to move you to another home, and everything in the moving truck that you were going to bring with you, or whatever new you were going to buy once you got to the home, that's your personal property. So there's your clothing, there's your furniture, there's your shoes, there's everything that you own. Now, one thing I want to touch upon is some insurance agents will try to save you a little bit of money here, but I always want you to understand, I never want a phone call that says, I wasn't covered for that, because there's a big difference in your actual cash value versus your replacement cost. Replacement cost is what would it cost to replace the value of that couch, for instance, which has depreciated over years. However, actual cash value is going to replace that couch for you brand new today's dollars. So there's a big difference, and that really plays a big difference too when you're talking about replacing a roof. If a roof has been on the house for 20 years, the value of that roof is only a couple $100 versus a brand new roof is $20,000. So you want to make sure that you understand what you're paying for and what you're covered for, because to me, it's not worth the saving the couple of $100 a year versus coming out with $20,000 once you have to make a claim. Loss of use. If I were to take your home away from you, if for instance your home was to catch on fire and the damages were unlivable inside, loss of use allows you to go live in a hotel, eat out at a restaurant, get your clothes dry cleaned, that sort of thing. So that's part of your coverage there. Then there's your liability. Your liability is somewhere between $100,000, $300,000, $500,000. And that means what you're liable for if somebody were to get injured on your property. So if somebody were to get bit by your dog, if somebody were to slip and fall in your driveway, if a kid was going to fall off a tree, if somebody's going to jump on a trampoline and get hurt or get hurt in your pool, that's your liability. That's what you're covered for. Your medical payments, the best way I can explain your medical payments is that if somebody were to get injured, your insurance company doesn't want to cough up the $100,000, $300,000 for liability. So what they say is, hey, we'll give them $3,000 for an example to take care of any medical payments and helps to wash their hands clean, right? And here's those two deductibles that we talked about last time. There's in your home, there's two different kinds, and depending on your carrier, there's the wind and hail, which is either equal to or more than your all other perils, because the biggest chance of damage to your home is wind and hail. Wind blowing shingles off your house, a wind blowing a tree over that falls on your house, that's usually going to be your biggest damage. One of the biggest claims in Michigan that not a lot of people have nor understand is water backup. So the difference between water backup and flood is water backup will come from your sewer, any type of pipe in your house, any type of drain in your house, whether it's the toilet backing up and overflowing, the drain in the shower, or the drain in the basement floor. Now, you may go find a house that doesn't have a basement. To me, that's even more of a cause to have water backup, because then your water's coming onto your main floor where your furniture, carpeting, so on and so forth is. Back in 2014, there was a major water backup in the Madison Heights, Royal Oak, Southfield, Oak Park area, where water wasn't exiting correctly and was coming back into people's homes, flooded their entire basements. Now, that's a water backup, and if you don't have that coverage, you're going to have to pull out all of your contents, all of your carpet, all of your drywall, and pay for that out of pocket to get that remodeled and repaired to where it's livable again, to prevent molding and further damage. Flooding is when water comes from outside your doors from rain or weather. Outside your doors, outside your windows, anywhere from the exterior of the home into the interior of the home, through doors, windows, garage, so on and so forth. Umbrella. So your liability coverage has a limit on your home. It can only go up to so much money, okay? But another coverage that you can get that's inexpensive, $10 to $15 to $20 a month, is an additional $1 million of liability. And this liability insurance covers you on not only your home, but your auto, your watercraft, your renters, your condo, your motorcycle, any of those. Now, if you say, okay, well, Jordan, I only own my car and my house, great. I still always recommend umbrella insurance. Here's two examples, too, that I have on the screen. And one of the examples that I like to give is, I called a client and talked to him about umbrella insurance, and he said, I had a neighbor. The neighbor opened up his door, his dog got out, and the dog bit the kid walking down the street. The kid's parents filed a lawsuit against the homeowner for $1.5 million. Now, their homeowner's own liability was only $500,000. So that means the other $1 million they had to come up with out of pocket. They're no longer his neighbors. They no longer can afford to live in that neighborhood and live in that home because of it. So for an extra $150, $200 a year to have $1 million in liability coverage way outweighs the cost. It covers you when you're driving. If you were to get in an accident and you were going to hit someone, the liability that they were going to come after your insurance for out of work, medical expenses, so on and so forth, is all covered. So that's what that one accident umbrella explanation is here with the car and the person, and the other one is about a child that falls off a playground in someone's backyard, kind of explaining what that big policy claim can come back and look like. Now, a couple of discounts. The way I explain insurance is, yes, I have 20 different carriers, but I want to take care of you as if you're my sister, my mother, my so-and-so. So I try to give you a behind-the-scenes explanation on, hey, here's things you should talk about or look at, even if I were going to give you a second opinion on your insurance, which is one thing I always recommend, is get a second opinion. Here's some discounts that could potentially may have not have been brought up that you should understand. One, if you have kids that are in school and they're getting a 3.0 or better, turn that report card in. It's going to give you a discount. Bundle your policies together, but always shop your home and auto together. There's a significant amount of savings that you can get when you can put those together. Companies don't want to print their policies anymore, and they don't want to send them over to you and print them and fax them and exchange hands. So e-signing is always a great one that you can save money on. If your home has a security system in it and you're going to activate that, or you're going to get one, that'll give you a home defense discount. Smoke alarms, smart devices, smart lights, smart different temperature gauges. Now we have the Nest, right? Any type of thing like that. If you put in a security camera, and even if it's self-monitoring or Ring camera or Ring doorbell, that's all discount. And I always tell people, if you can afford to pay in full, if your homeowner's insurance is affordable to pay in full, you will get more back in return in that savings than you would investing money. A couple other things to help out Jeremiah and Nick is, if that is your dream home and they both talked about kind of the money coming in and debt to income ratio. I can always work with you on adjusting your deductible to make sure that that home is within your budget, as well as if you are need a quick turnaround. It literally takes me, under an hour to get you a quote with all 20 of our carriers, turn over and get that approved with your mortgage lender to get you a deck page, so that way you can go to close. If God forbid anything were to happen, I've got you. My availability is also a Saturday like today, Friday evenings, you name it, you call me. You got my cell phone. I'm available.
Yeah. Hey, Jordan, thanks for going through that, man. That was awesome, because we get a lot of insurance people that just quote rate and the client doesn't even know what they have.
Yeah.
We have no idea. Like, shoot, you were mentioning loss of use. I had a hurricane 2 years ago. I was like, oh, I had to pay you out of pocket for a hotel. I wish I knew that.
So many people don't understand what's in their policy, right? Yeah. They look at it and they go, okay, I need homeowners insurance. Okay, it's $1,000 a year. Great. Can we tweak anything? And the agent will tweak things, but they'll tweak the wrong things. And that's why I kind of want everyone to understand what's in your policy. What are you actually paying for? What is your coverage? Because if you don't know things like that and you go and pay for a hotel out of pocket, you were covered for that.
Yeah, no, absolutely. Absolutely.
Yeah, absolutely.
Good stuff. All right, awesome. Do we got any questions at all? Should we open up to questions, Mike?
Go for it.
I got a question. If you don't have 20% down, do you have to have PMI?
Yes and no. Yes, you're always going to have mortgage insurance or PMI if you don't have 20%, because that covers the risk for the lender in case of default. We can always buy it out, build into the rate. There's a lot of different mortgage insurance options we can have, though. But you're always going to have that if you have less than 20%.
Okay.
And, just to piggyback off of that is that, let's say that, you don't have the 20% and you go ahead and buy a house, in a few years, you could always call your lender and say, hey, may I, take the step. I feel like I'm at 20% equity. Can we take the steps to remove it? Because they don't always tell you like, hey, you hit 20%. You could always ask them, hey, let's take the steps to see if I've hit 20% equity to remove the PMI off your payment.
Yes. Yep. Yeah, they won't.
Yeah, exactly.
They definitely won't. One thing we do is I keep you in a database as well. We always give you that's one thing we do as being one of our clients. It's one reason I've been doing this 27 years. Put you in a database. I'm actually what's called a certified mortgage planning specialist, which is just another designation. What that does is allows me to look at your whole situation. Because as I mentioned earlier, your mortgage is your biggest debt. Your home's your biggest asset. So we always want to make sure you're always in the best mortgage at any given time. Because you have life events. You have things that happen. You have, I've seen you have a couple of small kids. One day they're going to go to college. So your mortgage asset to use that. You might want a debt consolidation, might want a home improvement. You might want to go to a 15-year mortgage. So there's all these things. So we do annual reviews with all of our clients once a year. And if the rates drop, one nice thing about Michigan is it's a very low closing cost state as far as refinancing. So I do a lot of free refinances for people. Call them up and say, hey, man, you had a 6%. I can go ahead and drop you at a 5% rate and it costs you nothing out of pocket. So we always do that for you. And bringing back to your original question of the mortgage insurance, we look at that as well. Like you might go to like I have an FHA loan right now. Which sucks because you have it was good for me at the time, but sucks because I have the mortgage insurance monthly, which stays forever on an FHA. I was looking at refinancing it. However, I got a 3.75% rate. So it doesn't make sense for me at this time to refinance into something else to get rid of the mortgage insurance because the rate's higher, my payment will go up. So,
one thing with that
we always look at that.
Is where I can help is I can take a look at taking a look at what you're paying for your renters and your auto insurance now to see if I could save you money. So if you take that $50 to $100 a month that you're saving and start to put that away, to help you get closer and closer to that down payment.
Cool. Yeah, and it's always it's a lot better too when you bundle your insurance as well too. As you mentioned earlier, you got everything under one roof. Makes it sense. You pay less. It's nice to have one person to go to as well.
Mm-hmm.
For sure.
All right, cool. And you have all our contact information. Asia will have Nate reach out if you got questions, or feel free to reach out to us if you want to contact Nick or Jordan as well. You have our contact information. We're going to throw them everyone's contact information that we're registered on here today.
Okay.
And we'll post this on Facebook so people can watch it who couldn't make it. Saturday is always tough. It's tough for me. It's nice outside, to be in here. So we appreciate it.
Was this a good use of your time? Did you learn something?
Yeah, I learned a lot.
Good.
Awesome.
A lot of information.
Yeah,
There's a
there's
lot of information.
Yeah, right. I would say digest. Yeah.
Yep.
I was getting lost with some of the stuff, but it's okay. I mean, I can always contact Nate and he can explain some stuff to me. So.
Yeah, we're going to constantly go over, as Nick mentioned, this could take, depending on when you start the process, like let's figure like right now is your first day you started. You got some information. The next step is to get pre-approved. Once you do that, now let's get you out to find a house and then close. And this could take 2, 3, 4 months. So we're going to constantly keep going over this stuff.
Yeah.
Okay, good. And I don't know if Nick's got some realtors up in Saginaw that can help you or not, but I would get with him if you need a realtor or anything like that. And Jordan, you cover the whole state, I believe, right?
The whole state.
Yeah, I've done Saginaw. Yeah, absolutely.
Okay. Awesome. Yep. So, and of course, we can help you on the mortgage side. So.
Okay.
Let's get you in a home. Your first-time home buyer, it won't be your last.
Yeah.
So we want to help you and everybody else that was on here. Appreciate everybody's time.
I have a question for you. During the process, is it true that they don't want you to finance anything?
Yes. Yep. What you want to do.
Question.
That is a really good question. Put everything in your Amazon shopping cart and do not hit submit until after you close and you have the keys in your hand.
Okay.
Give you an example. We had somebody, one of my loan officers, help somebody out that bought a house. Actually, this was in Michigan. They went out and bought $25,000 worth of furniture because the furniture guy said no payments for 12 months. Well, we do a credit, a soft pull before you close to make sure you didn't finance anything. Because remember, in the beginning, we talked about debt to income. Let's say I have you on an FHA and your debt to income is maxed at 57. Well, now you go finance something or buy anything, even though you don't have payments for 12 months, you're going to have those payments eventually. So now I got to add those payments into what your debt to income, and it could make you not qualify. That's exactly what happened to this client. It's like, well, now you got furniture, no house to put it in because we can't qualify you. So before you make it, we'll tell you don't have your credit pulled, don't make any large purchases, don't do anything until after you close.
Mm-hmm.
Yep, lease a vehicle, co-sign for anybody. Also, and I hate to have to mention it, but I always tell my clients during the process, because it's happened 3 or 4 times this year, don't spend your down payment money. So if you've got your money, I had one client get all the way to close and he's like, well, I don't have the money. He had it in the beginning, but he spent it. I was like, well, I didn't think I had to tell you not this because you need it to bring to closing. You have to bring the money to closing. So that's something. If you need $6,000 for closing, hold on to that. Don't spend it. Don't make any large deposits unless you can verify it. Don't finance anything. So, yeah, that's a really good question. You guys got anything else to add to that? Or?
No, but I
no,
like
that's it. That's exactly right. Fly under the radar for 45 days. And then after you close, you can do whatever you want.
Yeah, my wife had everything when we bought our house in the shopping cart. After we closed for 2 months, I was getting packages at my door. She's like, can I hit submit? Can I hit submit?
So
I was like, all right.
45 days. So put things in the shopping cart for 45 days after your closing and all that. Then go ahead and go to checkout.
Yeah,
once you got the keys in your hand. Yeah. Wait till you got the keys. Once you can do whatever you want.
Yeah, do whatever you want after the key. Right. You can go ham on that. That's no problem.
Yep.
Okay.
You know, if you have any questions too, don't be shy. You can you've got my cell phone number, and you could text me anything. You know, risk free. Just for advice, just second opinion, anything.
Yeah. Yeah.
Okay.
Yeah, and that's a good point. Is that, like, good, with information comes good decision making. You know what I mean? The more information you get, the more confident you're going to be in whatever decision you make. And that's what we're all here for. This isn't like
Okay.
a stop and go thing. It's an ongoing process,
And
Because
one thing I'd like to mention
told
to
that
everybody
just
here.
because you're pre-approved, that doesn't mean that you're going to be definitely approved for that amount. That's just a pre-approval amount.
Yes. Yep. It's a pre-approval amount. If we send you underwriting, I mean, obviously, let's say we get you pre-approved at 150,000, right? But we're estimating, because we don't have a property, we're estimating $200 a month for taxes, right? Well, now you find and no HOA, let's just say. Now you find a property at 150, but the taxes are 300, and now there's a $100 HOA. You might not qualify for that particular property. So that's another reason you want to get with your realtor and your lender prior to submitting the offer, so we can go over the payment and make sure, hey, okay, you're still approved for this. Because here's the thing, if you buy a single family residence in a condo is most likely going to have an HOA, which could be an extra $200 to $300 a month. So you might not qualify for 150 on a condo as you would on a single. So there's a bunch of variables in there. Okay. So, but again, once you get pre-approved, your loan officer, hopefully would be me or my team, would be able to go over that with you. Say, hey, 150,000. Here's your principal interest. Here's your estimated insurance. At that point, you would reach out to Jordan or whoever you want to use for insurance and say, give me a quote, so we have an idea what insurance will be. Your taxes are going to find out the property, and then any mortgage insurance or anything like that. Okay.
Like I said, I've been looking online, and I've been looking at some homes. And I've actually had a realtor take me out and look at some homes. So when I look at them and I see on the website, okay, this is what your payment will probably be. But then when I take out the 20% that I don't have, and I see it's a lot higher.
Yeah, that's about.
I would not go off of
It's an advertisement.
That's a blanket estimate. Like, they have no idea your specifics. So I would do your best to stay away from that and just get right to the source, which is a loan officer for sure.
Okay.
Yeah. And one thing you want to do too, and I can't stress this enough. I know you're out there looking, but definitely get pre-approved, because human nature, you're gonna fall in love with something.
My stuff already.
Oh, have you? Okay.
Yeah, I've been pre-approved. So.
Awesome. Good.
Yeah. Just gotta send in some more paperwork, but that shouldn't be a problem. I'm good on that.
Well, make sure you send in the paperwork, because I'll give you a good example too. I've got somebody who was pre-approved for $270,000. This is just this week. Well, then they want to get pre-approved through me. The realtor said, hey, check out. Now I'm looking at the documents, and they're only pre-approved for $200,000. So the previous loan officer didn't look at all their stuff because she had a business and there was a bunch of losses and things like that. So get your paperwork into your loan officer as soon as you can, so that way.
I definitely will.
Okay. Awesome.
If I didn't have to be at this meeting at noon, I would have went to my bank to get my like I said, I had T-ball for my son. I would have went there, got the 2 months of bank statements to send to him, but that's the only thing I don't have. So. Okay. Yeah.
Okay. Awesome. All right. Well, get out. Go to the bank. Oh, it might be closed now. 1:30. All right, guys. All right. Well, hopefully everyone can enjoy the rest of the day. We'll be on. We'll put this on Facebook Live, and we'll all be in touch. I'll be up in Michigan next week.
Okay, yeah, man.
I'll see you then.
Okay.
Take care. See ya.
Sounds good. See you guys.
Bye.
Yeah. Bye.